Right before our eyes, a financial drama is unfolding that analysts are already calling the economic earthquake of the decade. China's largest state-owned companies, from energy giants to infrastructure behemoths, have quietly begun canceling loans denominated in US dollars. Instead, they are switching to financing in Chinese yuan, a move that could send shockwaves through global markets and, according to legendary investor Scott Bessent, put $756 billion worth of U.S. Treasuries on the edge of collapse. At first glance, it might seem like a simple financial restructuring. But behind the scenes, experts warn this is far more than corporate bookkeeping. According to Bloomberg and Financial Times, the decision follows a series of high-level meetings in Beijing where top officials discussed ways to reduce China's dependence on the US dollar, a dependence many in the Chinese leadership now see as a strategic vulnerability. For decades, China has been one of the largest foreign holders of US Treasuries, effectively financing America's national debt in exchange for a safe place to park its massive trade surpluses. But that relationship is changing rapidly. Insiders in Beijing call it a de-dollarization in real time, a quiet but determined effort to break free from what they describe as Washington's financial dominance. And now, this shift is accelerating. Sources close to China's finance ministry told Reuters that the government has been signaling major corporations to issue debt and secure credit lines in yuan rather than dollars. State banks, including the powerful Industrial and Commercial Bank of China, have reportedly been instructed to prioritize lending in RMB for both domestic projects and overseas expansions. The logic, according to Chinese policymakers, is simple. Every dollar of debt avoided is one less link in the chain tying China's economy to America's monetary system. And after years of sanctions, tariffs, and financial threats from Washington, Beijing seems determined to remove as many of those links as possible. But for U.S. markets, the implications could be devastating. Scott Bessent, founder of Key Square Capital and former chief investment officer for George Soros, warned in an interview with CNBC that if China begins unloading its U.S. Treasury holdings, or even stops buying new ones, America could face a once-in-a-generation bond market crisis. China holds over $750 billion in treasuries, Bessent explained. If they reduce their exposure even modestly, yields will spike. Borrowing costs will rise, and the U.S. will feel the pain almost immediately. Already, the U.S. Treasury market is under stress from record levels of federal debt and rising interest rates. A sudden withdrawal by one of its largest foreign creditors could tip the balance from manageable risk to full-blown crisis. According to analysts at the Brookings Institution, this is not just about economics, it's about power. For decades, the dollar's dominance has given Washington unparalleled leverage over the global financial system. From sanctions on Iran to freezing Russia's central bank assets, the U.S. has repeatedly used its control over dollar transactions as a geopolitical weapon. Beijing has been watching closely. And now, experts warn, China may be preparing its counterpunch, one that strikes not with missiles or tariffs, but with bond sales and currency swaps. As one Chinese economist told Nikkei Asia, why should we keep financing a country that threatens our interests? The dollar is America's weapon. Maybe it's time we put it down. Behind closed doors in Beijing, the shift away from the US dollar is being described as nothing less than a strategic reset. According to insiders quoted by South China Morning Post, senior officials from the People's Bank of China, the Ministry of Finance, and top state-owned enterprises have been meeting for weeks to coordinate what they call a long-term de-dollarization roadmap. At the heart of this plan, analysts say, lies a simple but powerful idea: reduce exposure to American financial pressure while boosting the global standing of the Chinese yuan. The timing is no coincidence. After years of watching Washington impose sanctions on rivals from Moscow to Tehran, and even hint at financial restrictions against Beijing itself, Chinese policymakers have concluded that dollar dependence is a national security risk. Experts at the Carnegie Endowment point out that China has been laying the groundwork for this moment for more than a decade. The Belt and Road Initiative has already tied dozens of countries to Beijing through loans and trade deals, many of which are now being settled in yuan instead of dollars. In recent months, energy giants like CNOOC have begun signing oil and gas contracts in RMB, while Chinese banks have launched cross-border payment systems designed to bypass the US-dominated SWIFT network. But the decision by China's largest corporations to cancel US dollar loans marks a dramatic escalation. According to Financial Times, it signals Beijing's determination to push de-dollarization from the realm of long-term strategy into immediate financial reality. Think of it as a stress test for the global financial system, warns one senior economist at the Atlantic Council. If the world's second-largest economy decides it no longer needs the dollar for trade, debt, or reserves, the consequences for U.S. markets could be historic. Already, bond traders in New York are watching China's next moves with growing unease. The U.S. Treasury market, long considered the safest and most liquid in the world, depends on steady foreign demand to finance America's $34 trillion national debt. If China starts selling even a fraction of its $756 billion in holdings, analysts at J.P. Morgan warn, yields could surge to levels unseen in decades, hammering stocks, real estate, and consumer credit in the process. In Beijing, however, officials insist this is not about provoking a crisis, but about protecting China's interests. As one anonymous source told Nikkei Asia, "We are not attacking the dollar. We are defending the yuan. The U.S. has weaponized its currency for too long. We simply want options." Yet, financial historians note that once confidence in a currency begins to erode, events can spiral quickly. From the British pound in the 20th century to the Asian financial crisis in the 1990s, shifts in capital flows have triggered chain reactions no one could fully control. And now, with the world's two largest economies edging toward financial confrontation, many fear we are approaching another such turning point. Across global financial capitals, from New York to London to Singapore, China's bold move is setting off alarm bells. The International Monetary Fund has already issued a cautious statement, warning that a sudden reallocation of reserve assets could destabilize not just U.S. markets, but the entire global financial order. In Washington, senior Treasury officials are scrambling to assess the risks. According to Politico, a classified briefing on Capitol Hill last week included worst-case scenarios: a spike in U.S. borrowing costs, a sell-off in equities, and a loss of confidence in Treasury bonds long considered the world's ultimate safe haven asset. Behind the scenes, White House aides are debating potential responses. Some advocate quiet diplomacy to persuade Beijing to slow its de-dollarization campaign. Others are pushing for financial countermeasures, including stricter scrutiny of Chinese investments in the United States. But, as one former Federal Reserve official told the Wall Street Journal, America's leverage isn't what it used to be. If China stops buying our debt, we can't simply order them back into the market. Meanwhile, in Beijing, state media outlets are portraying the shift as a logical step toward a multipolar financial world. Commentaries in People's Daily argue that relying too heavily on the dollar exposes countries to political blackmail, citing recent U.S. sanctions on Russia as proof that Washington wields its currency like a weapon. This narrative is gaining traction far beyond China. In recent months, Brazil, Saudi Arabia, and even France have conducted energy or trade deals in currencies other than the dollar. The BRICS alliance has openly discussed creating a new reserve currency backed by commodities such as gold. For the first time in decades, serious alternatives to dollar hegemony are being explored on a global scale. Scott Bessent warns that the $756 billion China holds in treasuries is just the tip of the iceberg. If Beijing leads a broader movement among emerging economies to diversify away from U.S. assets, the treasury market could face an unprecedented liquidity crisis. It's not just China, Bessent told CNBC. If others follow, the dollar's status as the world's reserve currency could erode far faster than anyone expects. Financial historians draw ominous parallels to the 1956 Suez Crisis, when Britain's pound sterling, once the world's dominant currency, suffered a fatal blow after geopolitical shocks and U.S. financial pressure exposed its vulnerabilities. Could the dollar be heading toward a similar reckoning? For now, investors are left guessing. Will Washington find a way to defuse the crisis? Will Beijing push even harder to build a yuan-centered financial order? Or will a sudden sell-off in treasuries trigger the very collapse everyone fears? As one analyst at the Brookings Institution put it, this is not just about bonds or currencies. It's about power, sovereignty, and the future of global finance. And the clock is ticking.